fees?
Yeah. So the way it works is we can finance. So the SBA has a minimum down payment requirement for all SBA lenders.
Yeah.
That's 10%.
Correct.
Some lenders require 15, some require 20. At Live Oak Bank, we typically go with 10% down. So we can finance 90% of the total project costs. So what are the total project costs? It's the acquisition purchase price, it's the working capital amount, the closing costs. So you add all those project costs up. Let's say the purchase price is $750, but with working capital and closing costs, maybe you're at $850 or $900,
right,
for the total project costs. Yeah. So we'll look at, if the cash flow of the business can support the loan, we'll look at financing 90% of the total project costs. So you're coming in with 10% of the total project costs. So we started at $750 for the acquisition, built-in working capital, closing costs. Let's say we're at $900,000 for the total project cost. The 10% down is going to be $90,000 of that $900,000 total project.
Yeah, so that number is increased.
So it is increased. Yeah.
And I don't mean that in a bad way, right? Yeah. So, and I tell people this, I'm like, listen, you have to understand that you've got more than the 10% for taking out the loan. And I don't mean more by that much more. But, you've got our side of things too, where you go telling somebody that, hey, listen, you gotta have your insurance in place, right? You gotta have your insurance bound before we close.
Yeah.
There's going to be maybe there's landlord issues involved. There's going to be some other stuff. Heck, even the down payment just to put into escrow for the deal itself.
Yeah.
So there's a lot of upfront costs that people don't realize, that they're like, hey, maybe I got $75,000. I can go buy that $750,000 business.
Right.
Well, the reality is, by the time you figure all that out, you could be easily double that number.
Yeah.
So, I don't want to scare people sometimes with that down payment or what they need up front, but it's not the 10% just for the loan. It is 10% for the loan, but that 10% is a little higher when you go ahead factoring everything in. And then to actually do a deal, man, you need to be overcapitalized on all these deals.
Yeah. Another factor that comes into play with the down, the 10, 20% is SBA lenders in general, they don't want you to put in every last dime for the down payment and then have nothing left over for what we call post-closing liquidity, personal liquidity. So
you can't be wiped out.
You can't be wiped out. You have to have a cushion, a personal cushion.
Right. And people don't realize that sometimes I need that in an account after the deal is over, waiting.
Right.
And if you guys don't see that in an account, we're not closing.
Right. And I wish I can put a dollar amount on what Live Oak looks for or what other lenders look for, but it's really it's kind of a scale, because it really depends on what's your personal debt load, how much debt do you have personally, and also the size of the business that you're acquiring. We're going to look for a lot more post-closing liquidity on a $3 million acquisition versus a $300,000 acquisition, right?
Would that number be affected? Like, again, we're kind of talking construction industry stuff, right?
Yeah.
So we deal with work in progress quite a bit.
Right.
So back to that working capital number, right? So would it vary based on industry like that? Like if somebody's buying a restaurant, which has no real working, there's no work in progress, versus, hey, I might have a window installer that they're buying windows this year and installing them next year.
Yeah.
And they might not be getting paid for another 60, 70 days after they're installed. So we could have money tied up for a real long period of time in some scenarios.
So that is going to be that really doesn't play into post-closing liquidity as much as it would the business operating capital that we would build into the loan.
Sure. Okay.
We would do it.
I didn't know if maybe it was a little of both.
Yes and no, but I personally compartmentalize those. As far as like construction and what the cash cycle analysis is on the company, that's going to play more into how much operating capital do they need. So,
I got you.
Yeah.
Yeah. So there's, there's, I guess you'd say in this scenario, there's really three factors that people need to consider. You've got your down payment money, right? You've got your money to actually close the deal, and then you have your post-closing liquidity. And sometimes people only consider that first little piece. I've got 75 grand. I'm going to go buy that $750,000 business. So at the end of the day, sometimes even the 20% that I'm telling people still isn't even enough.
Right.
And when you tell people 30%, they lose their mind sometimes. And I'm not, I'm not one that wants to crush people's dreams. Just because mine were crushed at one point. Thanks, Mike Shea. But no, right? So it's the more we know, the better prepared we can be, and the more we're just not surprised. I just wish that more people did know the whole scenario or what they need to do a deal, which is why I think our world is kind of not as upfront and open as other industries. And people may know about the businesses, but again, if they have to work with a lender, there's scenarios that you have to work through to be able to make these things happen.
And I try to, on an intro call, the very first call with a prospect, I'm very transparent. I'm not a huge fan of the element of surprise. So we talk about these things. We talk about the personal guarantee, the fact that SBA may require them to pledge, personal property as collateral. We talk about, where's your down payment coming from? How much you can have left over? I try to dig into those on that very first call, so we can set the expectation, with the buyer and the seller and you as the broker. That way we know up front out of the gate, what we're working with. But, it's really important.
But even some buyers, right? The buyers really know sometimes what they're even looking for. I mean, I can't tell you how many people call me and they're like, I'm agnostic. I just want something that cash flows. Me and my wife are going to, be involved in it or not, right? So I think sometimes they do those initial calls with you guys and they have the generic conversation. And then as they start doing the search, they don't go back and talk to you again. And say, hey, listen, I'm going after construction because, man, the margins are awesome. Or, this is really kind of where I want to be. And then all of a sudden it's skewed, right? We're out of whack.
I mean, that's a great point. They could be coming from a retail background and, they finally isolate their search. Like you said, I want to do construction. We need to have from a lender to buyer perspective, we need to have a conversation about that.
Right. Let's take that scenario. So let's say somebody's coming out of retail, right? And then they want to go into a construction trade. Are you guys, I don't want to say aren't you going to give somebody a loan in that scenario? But, what does somebody have to do to be able to jump that gap, right? To get you guys on board with, hey, I can do this, or I can make this jump from my industry over to this other industry.
From a general perspective, I think for SBA lenders in general, I think it's going to be very difficult to obtain SBA financing in the construction industry if you don't have at least some transferable skills.
So you're saying there are gaps that are too far to jump.
There are gaps that are very far to jump.
And again, so everything's case by case with us, right? But again, I try to tell people, hey, listen, go back to your lender, and your lender is going to tell you whether that gap is too much or not. And there's one more with that. So speaking along to the gap, right? And I've had this conversation with people recently because everybody's looking for an absentee ownership. Everybody's like, the last guy I talked to, he's in Michigan or I think it was Michigan. And he was looking down here in Florida for a cash flowing business. And he was going to take out an SBA loan. And I'm like, hey, man, have you talked to your lender about you living in Michigan and owning a business down here in Florida? Like, talk to me about the distance gap in scenarios like that.
So I think that's relocation, absentee ownership is very difficult.
This guy was not going to move.
Okay, so not going to
Not
move.
going to move. They were going to stay in Michigan. Him and his wife were going to absentee run it, maybe fly down a couple of times. And they wanted to buy something in Central Florida.
So the only was the business the type of business where the seller was on the ground going into an office every day, or in the market, or was it like a business that was run remotely and the seller just happened to live here in Florida?
This was an actual retail type location.
Okay. Yeah. So in that particular situation, I think you're going to be very hard pressed to find a lender who's comfortable financing that if you're not relocating.
So if you're not, you're not looking for somebody to become owner operators necessarily, but you need somebody to be nearby and involved in the business. Is that an accurate statement?
Yeah. I mean, and ideally they should be owner operator. I mean, SBA discourages absentee run businesses, absentee ownership.
Yeah.
So ideally they should be involved in the business in some capacity.
Right.